Okay, let's talk income tax. Okay, so this is every doll's favorite topic, right? So, um, everybody who earns money in the United States has to pay income tax um, for federally. Not every state has state income tax, so we're not going to talk about states, but we are going to talk about federal. And there's a specific way that federal taxes are calculated. Most people don't do their own taxes. I myself use an online thing to help file it for me and makes it user friendly. But it is a good idea to understand kind of how tax works and what kinds of things affects it. So just a few basics about income tax. Gross income. This is going to be everything that you make. It's going to be all of your wages, any tips you make, if you have a business and you make a profit from it, if you have interest on any like savings loans, or if you have like stocks that get dividends, it's all of the money that comes into you during the year. So everything. That's why it's called gross, because gross like encompasses everything. Okay, but then you have what's called adjusted gross. Which I abbreviate as AGI, adjusted gross income. This is going to be your gross income, so all of the money you have coming in, but you're going to subtract out any contributions for IRAs or any other tax deferred savings plans. So what tax deferred means is saying, okay, I'm not going to pay taxes on it now. I'm putting money aside so that I can have that income later. So you're not paying taxes on it now, but you will count it as income later when you start using it. So that's why it's called adjusted gross income. Okay, we also have what are called exemptions. So exemptions are a fixed amount per person. So in 2017, it was $40.50 for most people. You can claim the exemption for yourself and each of your dependents. Fortunately, this is no longer used, but unfortunately for you, you still have to answer questions about it because my math lab in this book has not updated since then. So you can understand it, but just know that this is no longer actually used in taxes nowadays. Okay. Okay, the last word is deductions. Just like it sounds, it's stuff you can deduct from your income. So this is going to be different for everybody. You have two options, either standard deduction or an itemized deduction. And you're always going to take whichever one is bigger, because again, this is a deduction, so this is something you deduct from your income so that you don't get taxed on it. So the standard deduction, this is like the minimum amount that everyone gets. So it's a set amount depending on your situation, your filing status, which we'll talk about in a second. So everybody gets at least this, but some people, if they pay more into certain categories, can actually add up all of those different individual types of deductions. And if all of that adds up to more than the standard, then you can take it itemized. So this is the minimum, but if you paid more in certain stuff, then you can get itemized. So that is stuff like interest on mortgages, if you contribute to charity, your state income taxes, that you had to pay, your local property taxes. So all that stuff you have to pay. There's more here, but those are just a couple examples. So if you add all that up and get an itemized that's more than the minimum standard, then you can claim the itemized. Just note that you can't get both of them. It's either one or the other. This is just the minimum amount, but you can get more. Okay, so the next word, sorry, the last one wasn't the last one. This is your taxable income. This is going to be your adjusted gross income, and then you should take off the exemptions and deductions. So after all that, that is what you finally calculate your tax from. So here's just a table. Summarize that. You start with your gross, you take off your adjustments, and you get your all the contributions to a tax-deferred savings plan. That gives you your adjusted gross. Then you take your adjusted gross and you subtract off deductions and exemptions, and that's going to give you taxable income. From there, you're going to calculate how much tax you owe based on the current rates. And then you can subtract off tax credits, which we haven't talked about yet, but we will, to get the total tax that you owe for the year. And then you can take off any payments or withholding that you've already done through the year. Like for paychecks, they usually withhold all of your federal tax. So they calculate all that you paid. And then if you overpaid, then you're going to get a refund. If you didn't pay enough, then you're going to end up owing money to the government. Okay, so let's practice just that first part. So Marie earned wages of $28,400. She received $95 in interest from a savings account. She was entitled to a personal exemption of $40.50 and took the standard deduction of $63.50. Find her gross income, adjusted gross income, and taxable income. Okay, so I'm going to kind of highlight all of the money that she got, all the information they give us. So we have wages of $28. We got $95 in interest. Personal exemption of $40.50. And standard deduction of $63.50. Okay, so those, we have four numbers here. So her gross income, so everything that's coming in. So her wages was money in, and interest from savings was money in. So you take the $28,400 and add on the $95. So her adjusted gross income was $28,495. Our adjusted gross, we're going to take the gross income, so all the money you got in, subtract off all the stuff you don't want to get taxed on right away. So that was, in this case, she didn't make any contributions to anything, so you're not going to subtract anything off, so it stays at $28,495. Okay, and not everyone does this. I don't do it. Probably should, but I don't. So if you don't make any kind of contributions to a tax-deferred account like an IRA, the adjusted gross is going to be the same as gross. Okay, so to get the taxable income, you can take your adjusted gross as $28,495. You can subtract off any exemptions. So it says an exemption of $40.50. That's what the government said. You know, everybody's going to get to take this off their income. It's like free money. And then you have the standard deduction. That's the only kind of deduction they talk about, so she's going to get the minimum of $63.50. So you subtract that off too. So you can put this in your calculator just like this, and you end up with $18.95. So our wages, she got $28,400, but she's only going to end up paying taxes on $18,000. Okay, let's try again. Again, if you want to practice this, go ahead and pause the video and try to do this on your own, and then come back and check. So LeBron earned wages of $3,452,000. Okay, so we have wages of that much. You receive $54,200 in interest from savings. Okay, contributed $3,000 to a tax-deferred retirement plan. Okay, he was not allowed to claim personal exemption because of his high income, but he did have itemized deductions totaling $674,500, which is definitely going to be more than the standard. So he's going to take that. Okay, so now we're going to find our values again. So gross income, everything coming in. So he has wages of $3,452,000, but he also got $54,200 in interest. So adding those up, he got $3,506,200. Okay, his adjusted gross. So you're going to take your gross income, subtract off any contributions. Now, he actually did a tax-deferred retirement plan, So he doesn't want to pay taxes on this now. He wants to pay on it later. So we're going to take off that $30,000 to get $3,476,200. Okay, to get taxable income, you're going to take the $3,476,200, subtract off any exemptions, which in this case is none, and deductions, so $674,500. And that comes to be $2,801,700. Still quite a bit of money to pay taxes on, but there you go. Okay, now let's talk about filing status. So your filing status is what is going to tell the government how much money, it gives a greater view on how much money you make. So if you're married and you have an income of $100,000, that's going to be different than if you were single and have an income of $100,000. And how much money you have to spend and use and all that. So tax calculations depend on your filing status, which is basically your like marriage status. So you can file as single. That means you're unmarried or you're divorced or you're legally separated. So you are only counting your own stuff. You don't have anyone else that will affect your income. Your income is all for you. Okay, and then if you're married, there are two different options. You can file jointly. So both you and your spouse are filing a single tax return. So you can put both of your incomes on there and you just include everything together. The other option is you can be married but file separate. So you file two separate tax returns, and so you have one person, so you separate all the income and to your specific income as well as all your expenses and all that sort of stuff. Sometimes it's better to do separate, sometimes it's better to do jointly. I think it depends on your separate incomes and all that sort of stuff. That's why I use a tax thing online, because it tells me which one's better. Okay, lastly, you have head of household. Okay, so this is when you're unmarried, but you have dependents. And a dependent means that you pay more than half the cost of supporting them. So whether that is a child or a parent or some other relative. So a dependent, you have to pay at least half of the cost of supporting them to count them as a dependent. So if you have that, then you're head of household instead of single. So there's two options for being married, and there's two options for being single. One with dependents and one without. Okay, so once you figure out your filing status, then you can calculate your income based on the current tax tables. Now, federal taxes, we have what's called marginal tax rates, where there are, depending on what your income is, you get charged a different percentage. So like the first little bit of it, you're going to charge 10%, and anything above that, you get charged additional percentage. Anything above that, you get more. So the more money you earn, the higher the rate is. So we'll talk about exactly how that works. So let's say Malcolm is single and earned wages of $23,700. He had $4,500 in itemized deductions from interest on the mortgage. Calculate his gross income, adjusted gross income, taxable income. Use the table below for exemption and standard deduction values. Okay, so first, before we calculate tax, we have to figure out what the taxable income is. So we do what we have been doing. So gross income. Okay, so you have wages of $2,370. You have $4,500 in itemized deductions, and that's it for what they give you. But he is single, so we're going to be looking at this column here, and this gives you the standard deduction and exemptions. Oops, sorry. So standard deduction and exemptions. Okay, so gross income, everything we have coming in, we have wages of $23,700. And it doesn't look like he got anything else in, so it's just the 23,700. Adjusted gross, we take adjusted gross, I'm going to subtract off any contributions, and it doesn't look like he contributed anything, so it's still 23,700. Okay, so now we have to figure out which deduction he's going to take, whether the standard deduction, the minimum, or if he's going to take the itemized. So the standard for him is 6,350. And itemized, he says, from interest from mortgage, he's got 4,500 in itemized deductions. So we compare these with the standard and itemized. This is the minimum, so it's going to be this or more. This isn't more than that, so we're just going to end up taking the standard deduction of 6,350. So to figure out the income, or the taxable income, we take our adjusted gross, subtract off any exemptions. 4050 per person. He is single, so he only has one. And then subtract off our deduction. And we end up getting 13,300. So he got 23,000 in wages, but he's only going to pay tax on 13,300. Okay. So again, one more time, using the table to figure out the taxable income, and then we'll talk about actually finding the tax owed. Okay, so Wanda is married, but she and her husband filed separately. So that means she's going to be looking in this table, or this column here. Her salary was $33,400. Okay. She earned $500 in interest. She had $1,500 in itemized deductions, 3 exemptions for herself and her 2 children. Calculate her gross income, adjusted gross, and so on. Okay, so for gross income, everything coming in. Well, she has salary coming in and she had interest coming in. So we do $33,400 plus the $500 in interest to get $33,900 as her gross income. Okay, adjusted gross, you take your gross, subtract off any contributions, and it doesn't mention any contributions. So this stays at $33,900. Okay, so should she claim standard or itemized? Well, standard for her category is $6,350. You might come here and itemized deductions. Looks like she has $1,500 in itemized. So again, we want to take the higher number, which is the standard. So to get the taxable income, you take the adjusted gross income minus exemptions. So here it says she has 3 exemptions. So you get like per person. So her and her 2 children. So we actually need 3 of these. So we're going to subtract 4050 3 times. And then I'm going to subtract my deductions. So remember, in your calculator, you can put all this in all at once. You do 33,900 minus 3 times 4050 minus 6,350. And we get 15,400. That pretty much cut her income in half, which is pretty nice when it comes to finding taxes. Okay, so let's go back to how to find taxes. Okay, so we have what's called a progressive income tax. What this means is that people with higher taxable income pay at a higher tax rate. So that was why we have this 10%, 15%, and so on. But we also have marginal tax rates, which I mentioned. That means that different parts of your income are going to get taxed differently. So just because you make $400,000 a year doesn't mean that you're going to get 33% of the entire $400,000. Only portions of it are going to get taxed at different rates, in different margins. Okay, so example. So we're going to use the tax rates in table 4.9 to compute the tax owed in the situation. So Bobby is married, filing separately the taxable income of $77,300. Okay, so what we're going to do is we're going to put this money into boxes. Okay, so she's married, filing separately. So again, we're going to use this column here. So what we're going to do is figure out how many boxes she needs. So each of these margins I'm going to consider a box. So her income up to $93.25 is going to be a 10% box. So from 0 to $93.25 is one box. Okay, the next box is from this $93.25 up to $37,950. So this is the 15% box. So it's those $93.25 goes in here, anything above $93.25 up to $37 goes in here. Okay, we haven't reached our income yet, so the next one is up to $76,550. It's 25% block. So $76,550. That's still not my income, but everything up to $76,550. So that means all three of these boxes total will have your first $76,550 income in it. Okay, so the next one after 76 is 116. Well, we don't make that much. So what we're going to do is we're going to make another tick mark for our actual income and make a box for that. And this 28% goes in here. So this is this, it doesn't fill up the entire box, it's just a little bit of the box. Okay, so what we're going to do then is figure out how much each box is going to be worth. So the amount of money in this box is $93.25. Okay, so it's your first $93.25. Now the amount in this box is anything above $93.25 up to $37,950. So what we need to know is the difference. So we're going to take $37,950, subtract off $93.25, and you get $37,950 minus $93.25. We get $28,625. So there's $93.25 in this box. There's $28,000 in this box. In this box, we're going to take our $76,550 because anything above $37,950 up to $76. So we're going to take $76,550, subtract off my $37,950. So it's $76,550 minus $37,950. And I get $38,600. Okay, and in this last box is everything above $76,550 up to $77,300. So I have $77,300 minus $76,550. And I get $750. Okay, so now I know how much is in each box. So each box is going to get taxed at this percentage. So what I'm going to do is 10% of this income. So I do 10% times $93.25 to get this income. And then I need 15% of just what's in this box. So it'll be 15% of $28,625. But this box is 25% of what's in here. So 25% of this $38,600. 25% of $38,600. And then 28% of what's in this box. So 28% of $750. So this gives me the tax for this box. This gives me the tax for this one. This is the tax for this box, and this is the tax for this box. To get the total, we're going to add them all up. So we're going to take 0.1 of $93.25 plus 0.15 of 2625 plus 25% of 38,600 plus 28% of 750. And I can put all that in my calculator all at once, and I get tax owed of 15,086. Round to the nearest dollar, because Uncle Sam does not want cents, they just want dollars. Okay, let's try this again. Example 6. Let's use the marginal tax rates to compute the tax owed. Jean is single and had a taxable income of $35,400. Okay, so $35,400. So this time we're using single, so it's going to be a little bit different here. So this time we're using this column here. So single, the first box is up to 9325, so this is the same as separate. Okay, and we made more than that. So that's my first box, that's that first amount. And then my second box goes up to 37,950, which is more than what I made. So I'm not going to go all the way to 37,950. I am going to end at here. So I have a smaller box. So I don't need to go all the way to 37,950. Actually, my bad. We need to put 35,400. Okay, if I do the entire box, it would be 37. But I don't have my entire box, so I'm just going to do a smaller box, 35,400. Okay, so now I need to know how much money is in each box. So in this box we have the first 9325. In this box we have 35,400 minus 9325. So 35,400 minus 9325. So we have 26,075 in that box. So the total tax owed, we're going to take 10% of what's in this one. And we need 15% of what's in that box. So we add those together and we end up with 4,844. Okay, the real world. Okay, so the IRS will tell you what the tax table is. So you can, if you wanted to, you can go up and look at the 2020 tax tables and see what it is. Sometimes, well, you can sometimes find this, which means you don't have to actually calculate anything. If you can figure out what your taxable income is, you can look at this table. So that first example we looked at for 77,000. So the taxable income we said was, let's go back to this one. So we had a taxable income of 77,300. So if you try to find the 77,300, that is here. And we said that that person was married, filing separately. So this is married, filing separately. And these are the two numbers we're looking at. 15,079 and 15,093. Now because this appears twice, then your tax owed should be between here, 15,079 and 15,093. And we said it was 15,086, which is in between there. It's actually halfway in between there. Now for the other one, we said the taxable income was 35,400. So I find 35,400 here, and this person was single. So we'd be looking at these two numbers, and the tax should be between these, 4840 and 4848. And we said it was $48.44. So if you have this table, it can help. Now, if you had like 35,402, then you can only get like an estimate, right? This is just for enrolls of $50. Okay, but we're not going to use this. This is just kind of an FYI. It's out there if you want to use it. Okay, now let's talk about tax credits and deductions. So credits and deductions, they're similar but different. So they both take money off of what you owe, but one comes before your calculations, before your tax calculations, and one comes after. So a tax deduction, it's actually the second one, is what we've been talking about. This is something that reduces your taxable income by the amount of the deduction. So this is only going to reduce your tax bill by your highest margin percent. So for example, if you had if you're trying to decide if like contributing to charity is going to make a difference on your income, and say you already have enough to get your itemized deductions, so you want to say, okay, I want to donate an additional $1,000 to charity. And let's say your taxable income is $50,000. Which puts you in the 25% tax bracket. So like if you're single, 50,000 would be in this one here. So the 25% would be your highest. That means your tax bill would only reduce by as much as 25% of $1,000, or $250. You're not going to get that full $1,000 off. The most you'll get off is that $250 in your tax. Now, a tax credit, on the other hand, this comes after you've done all the marginal tax calculations. You've already used the table, you've taken all that sort of stuff off, and then you take the tax credit. So this is like basically saying, okay, I'm going to assume you already paid that money to your tax. So it's not a deduction, but it's like a cash towards your tax. So this is going to increase your tax bill by the full amount. So if you had a $1,000 tax credit, you're going to get that whole $1,000 off your tax bill. Okay. Let's practice using this. So we have Paul. He's a head of household with a taxable income of $89,300. He's entitled to a $1,000 tax credit. Okay, what is his tax owed? Okay, so he's head of household. So we're now going to be using this column at the end. He's a taxable income of $89,300. So $89,300 is going to put him here in this 25% range. So he's only going to have 3 boxes. The first box is up to $13,350. That's his first box. Second box goes up to $5,800. And his third box just takes him up to $89,000. Now, it doesn't really matter where at in this box it goes, but okay, so he's got 3 boxes. The amount of money in this box is $13,350. Oops. $13,350. And in this box is everything after 13,350 up to 5,800. So we want the difference. So there's 37,450 in this box. And this is anything above 5,800, so we do 89,300 minus 5,800. So we have 38,500 in this box. So to get the tax owed, we need to find 10% of this one, 10% of what's in that box, 15% of what's in that box, and 25% of what's in this box. Okay, and so that's going to give me 16,578. Okay, so this is just based on tax income. Now we're going to say he has his tax credit. So this is basically saying the government saying, I'm going to give you $1,000 free money to put towards your taxes. So we can take this off of his bill. To say that now he only owes $15,578 in tax. Okay, example 8. Okay, Winona and Jim are married and filing jointly with a taxable income of $105,500. They are entitled to a $2,000 tax credit. Okay, so this time we're looking at married filing jointly, and they have $105,500. So that is going to put them here again in the 25% tax bracket. So they have 3 boxes. First one goes up to $18,650. That's my first box. Second box goes up to $75,900. The third box is smaller than the end, so we have $105,500. Okay, this time I'm going to do it just slightly different. You can still do it like we've been doing it. This time I'm going to do all my calculations all at once. So I know I take 10% of what's in the first box, which is always just that first number here. And then 15% of the difference here. So I have 75,900 minus 18,650. And so this is the amount that's in there. I had to find the difference here. And then 25% of what's in this last box, which is going to be the difference between these two numbers. So we have 105,500 minus 75,900. I put all that in and I get 17,853. Okay, so this is how much they would owe based on their income. But they have a $2,000 tax credit. So again, this is a credit saying, okay, I'm going to say that you've already paid this. So if we take off that $2,000 credit, it brings it down to 15,853. Okay, so the last thing we're going to talk about is a marriage penalty. So what we're talking about here is because we have different margins for single and for married. Sometimes you might want to say, okay, is it should we get married at the end of the year, or should we just wait until the beginning of the next year so we can file? So should we file single, like wait to get married till the beginning of the year so we can file single, or should we go ahead and get married at the end of the year and file married the next year? Because remember, even if you get married at the end of the year, if you have to file married, but you act as if you're married the entire year. So depending on your certain circumstances, you may want to just wait so you can file single. So here, let's see if Joan and Paul are in a situation where they need to wait, or if they can go ahead and just get married, and see if it will affect their taxes. Okay, so Joan and Paul have adjusted gross incomes of $32,500 and $29,400 respectively, which means that this is Joan and this is Paul. Assuming each person takes one exemption and standard deduction. Okay, so we don't have to worry about all the itemized stuff. So calculate the tax owed by the couple if they delay their marriage until next year so they can file their tax returns as individual and single rate. Okay. So if they delay their marriage, they're going to file as a single rate. So we're going to be using this table. So if I set up my boxes here, start at 0, and for single, okay, and we'll look at Joan first. So single is up to 93.25. My first box. See, she made 32,500, so she doesn't even make it all the way through that one. So she just has 2 boxes. The first box is 10%. Second box is 15%. Okay, so I don't actually need all of that. Okay, so her tax is going to be 10% of the first amount, 93.25. Notice this time I put the 0, but because it's at the decimal point, it doesn't really matter. You can put 0.1 or 0.10. And then it's going to be 15% of what's in the second box, which is going to be the difference between 32,500 and 93.25. Actually, I made a mistake here, didn't I? Notice this says this is adjusted gross income. I have to actually find the taxable income first. Before I can calculate the tax owed. Because standard deduction and exemptions, or standard deduction at least, is going to be different whether they're single or married. So for taxable income is going to be either 32,500, subtract off any exemptions and standard deduction. So she gets 1 exemption, so that's 40.50 from the table here, and the standard deduction is 63.50. So that brings her income down to 22,100. Looking at the table, it's still in the second box, so she still needs 2 boxes, but this is just going to be 22,100 instead of the 32,500. Okay, now we can figure out the tax. So it's going to be 10% of 93.25 and 15% of 22,100 minus 93.25. And that gives me 28.49. Okay, so her tax is going to be 28.49. I'm going to get Paul to get his taxable income. His starts with 29,400. He has 1 exemption as well, and standard deduction. They're both singles, so it's going to be the same. So we subtract that, and we get an even 19,000. So 19,000, and the single is still in the second box. So he's also going to have 2 boxes. First one is 93.25. His end is 19,000. First box is 10%. Second box is 15%. So his tax is 10% of 93.25 and 15% of 19,000, which is 23.84. So to get what they owe total, you're going to take the 28.49 and add it to the 23.84 to get a total amount of 52.33. So if they both file single, they'll pay a total of 52.33 together. Okay, now let's look at what happens if they marry before the end of the year and they file a joint return. Okay, so that means they have a total AGI of 32,500 plus 29,400, which is 61,900. Okay, so to get the taxable income here, we take the 61,900. Now we're filing joint, so we have to look at this one. Exemption per person is 4050. Now there's two of them, so we subtract off 2 of the exemptions, and standard deduction is 12,700. And that gives us a taxable income of 41,100. Okay, now we got the taxable income, we can figure out the tax. So we look at married filing jointly. 41,400 is in this second box, so we're only going to need 2 here. So the first box ends at 18,650. Second box ends with their income, which is 41,100. First box is 10%, the second box is 15%. So your tax then would be 10% of the first 18,650, and then 15% of what's in the second one, which is a difference of 41,100 and 18,650. And this comes to 52,33. So in this case, whether they file single is 52,33. If they file joint, it's 52,33. So in this case, there is no marriage penalty. That doesn't mean that there's never marriage penalty. Sometimes there actually is, depending on their incomes and whether they filed separate or jointly. But in this case, they can get married now and file jointly, or they can get married later and file single. Tax-wise, it's not going to make a difference. And that is it for that section.